Thanks for having me, Andrew.
Cole, how are you playing the oil market right now? Are you buying Canadian oil stocks, for example?
Yeah, if you go back to Ash Wednesday on March 5th, that was kind of the height of the fears over tariffs and really the oil market in general. I would say it was the depth of the saber rattling of the Trump administration. And it's really interesting, Andrew, if you've noticed, oil is not much higher than what it was on that date. And what's happening in response is the stocks in the oil space, like the Canadians that were punished over tariff fears, as well as just the oil stocks in general in North America, are all rallying despite the price not moving. And in my opinion, and our opinion as a firm, March 5th was the second best buying opportunity the last 20 years in the energy business. Now, the only other one being the depths of 2020. The big difference that I think people are missing, Andrew, is then you had to believe that there was going to be a recovery. You had to have faith that that was going to happen in the price of barrel oil as production shut off. You had to believe that the balance sheets were going to unlever. They had never, really looking back 10 to 20 years. And you had to believe that they were going to become rational and logical in their capital allocation to return that capital through buybacks and dividends to shareholders. And that required a lot of faith. I do not believe this requires that much faith at all. This requires courage. This requires logic. And to be honest, this is not a space that historically has a lot of investors with those two attributes.
So the Canadian oil stocks, I think your thesis right now is that it's cheap. You can buy oil cheaply on Bay Street.
Correct. There's no question to that. If you look at the returns on capital of these businesses, the only way someone would be putting new assets in the ground would be if they can produce an internal rate of return above and beyond the parent company today. And at these prices, it's going to be very hard to find that. And so I think what you're going to see is maintenance CapEx. I think you're going to see a lack of investment. I mean, just to give you a picture of this, I think the greatest capital allocator I've ever seen in North America is Harold Hamm, okay? He is out talking about this week that at Sarah, he said that no one's going to produce any new oil production below $80. At the same time, he's signing an agreement with the government of Turkey to go out and possibly do a project in Turkey. Now, what is one of the greatest oil barons, from Oklahoma doing in Turkey? And the answer is, well, there's probably some subsidy. That's not going to happen here. So the idea of drill, baby, drill, that sounds like a great song. Chris Wright, a former energy executive, is now, the energy secretary, but he's doing what Trump would like him to do. The energy industry is not following them along.
That's interesting. Harold Hamm, of course, of Continental and of the famously huge divorce settlement, I seem to remember. So the message has been...
That's a first world problem, Andrew.
Yeah, that's right. Yeah, I don't think he was let bankrupt by it. So I'm trying to think. So the prospect for massive shale production increases, you don't think that's going to happen?
No, I think, in fact, this could precipitate the beginning of the decline of the Permian. Because, again, at these prices, there's no incentive to even maintain some of your barrels. We could plausibly see year-over-year decreases. And so we're in the peak Permian era. And unless prices go higher, you're going to have trouble doing that. Use what Sheffield said a few weeks ago at Sarah. I mean, before the deal, before Pioneer sold to Exxon, he said we have 16 years of inventory. Then, once he's no longer on the board of anything and he's not an executive, he's not captive, he came out and said the truth. He said that Pioneer had 4 years of Tier 1 inventory and 4 years of Tier 2 inventory, which means it was half as much as he said prior to the deal. So again, the idea that everyone has the assets to get through this and they're all going to be able to just deal with this easily, no, there is not enough rock out there at these prices to incentivize continuing barrels. And again, Canada's one positive is since most of the barrels are tar sand assets in Canada, that is maintenance CapEx. I always tell people, yes, someone wasted money years ago building these assets, and the great part is I'm glad they did that, and I don't have to waste that capital. We are maintaining those barrels through primarily maintenance CapEx, and the long life nature of these Canadian assets is what I think the long-term tailwind into this tight supply market is.
You have some stock ideas for us, starting off with Imperial Oil, the Exxon subsidiary. Now, they, of course, went through massive capital expenditure quite a few years ago, developing Kearl, the big oil sands asset. You like the look of Imperial Oil right now?
Yeah, Imperial Oil is like running a family business in Regina, Saskatchewan, as a town, small town, kind of idea. And your rich uncle, aka ExxonMobil, owns 70% of the stock. You get all his bank credit, like the local bank would provide you with a rich uncle. And the catch is that you think with that much advantage with your rich uncle, he would take advantage of you. And the answer is no. They're doing buybacks. The rich uncle is selling into those buybacks, which me as the minority investor means I have an advantage. I don't have to worry about getting too big. ExxonMobil does. Their ultimate fear, I believe, in my opinion, is that they fear that the government would nationalize the asset if they owned 100% of it. And so we get to take advantage of an oddity in the stock market. It doesn't make any sense why they don't wholly own it, but they just choose not to. And so therefore, we will take their great economics and financing. We will not sell back in the buyback. And what you've seen in that stock is it's actually one of the best performers among the majors because ultimately their capital allocation is rewarding around what they're doing.
Cole, I know that you also like the look of Strathcona, Synovus and Meg, but we're just out of time. But I hope you come back soon, and thank you very much indeed.
Thank you so much, Andrew. Appreciate it.
Cole Smead, CEO of Smead Capital Management.